bear with me one moment here. I have to go real quick. I got to jump back through all the slides because apparently I was sitting at the end. So it is April 11th, 2023, the start of the second quarter for the year. This is our economic update, really kind of talking about what it is that we're looking at in the overall market, some of the things that Mike and I are thinking about. This one is a little bit shorter than normal because it is tax time. Mike and I are hard at work making sure, Mike, myself, and the team are hard at work at making sure that we have everybody's returns processed on time. If you got everything to us before April 1st, we're trying to make sure all the information is done. If by chance you're not going to be done in time, you will be placed on extension, and then you'll be finished up pretty shortly thereafter. As I said, my name is Brian Herbert. This is me over here. And then everybody knows my business partner, Mike. You know, we've been featured in a lot of different places over the years. One of the things we just received was we won Best of Central Maryland from What's Up magazine for Best Financial Advisor in Central Maryland. So Mike and I are very happy about that. You know, this is just our disclosure here. The information is really for information purposes. It's really the things that we think about, not a crystal ball, just the factors that we think about when we're making our decisions. You know, big thing, I just kind of wanted to recap this because these are a lot of conversations that I've been having with clients and with prospective clients, is that Secure Act 2.0 was passed right at the end of the year. Last year, it increased the annual catch-up amount inside of employer-sponsored retirement plans up to $10,000 for those between ages 62 and 64. It now allows for matching Roth contributions because the 401k plans that had Roth 401ks attached to them, when you would put your money in, your money would go in Roth, but your company's match would actually go into the pre-tax account. So now it does allow for Roth matching contributions. So that's really a good thing. So that, you know, the whole point is to get as much money over into those Roth accounts as possible. So that way, when tax rates go up in the future, as much money as we can have in Roth accounts, the better off you'll be because that's all tax-free. For kids and grandkids, it allows employers to make 401k matching contributions based on the student loan payments they're having to make, and this is even if they're not making those contributions themselves. So this helps out younger Americans who are struggling with their college debt to save for retirement. Another big thing is, you know, the requiring 401ks to start offering an annuity option inside of those employer-sponsored retirement plans. You know, the federal government with the TSP has been doing it for years and years and years. Where on the side of your statement, you saw a number that says if, you know, based upon how much money you have in here at age 62, it's going to provide you $1,735 a month or whatever it happens to be. So it is encouraging Americans and investors to think about using annuities as useful tools for creating income in retirement. That's one big part of it. They're really trying to get the U.S. taxpayer, the U.S. citizen, the U.S. retiree, your reliance on Social Security, off of Social Security, and kind of defer that risk onto insurance companies. The biggest change to the Secure Act that affected a fairly significant amount of people this year was that the RMD age, so that the age of the required minimum distribution for those of you who have to start taking money out, it was 70 and a half, then it was 72. Starting this year, it is 73. So anybody who reaches age 72 after December 31st or after last year and reaches age 73 before January 1st of 2030, that's when you have to start taking those required minimum distributions out. And as the law stands right now, at age 75, starting in the year 2033, so all those people who are going to reach it after 2032, that's when the new required minimum distribution age will be. Really what they are doing is they're encouraging you to leave your money inside of those accounts for a longer period of time. The cynic in me says that they're wanting you to leave the money in there for a longer period of time so it can grow to a bigger number. Therefore, the RMD that you have to take out becomes a bigger number, and the amount of money that they get to tax becomes a much larger number. Therefore, they are raising their tax revenue without actually raising your taxes, is kind of their loophole to doing this. So it's one of those things you want to be aware of. You want to make sure that you've taken the proper RMD amount by the end of the year, because if you don't, the penalty for not taking out is 50%. So on to really kind of what it is that Mike and I are looking at in the overall market. You know, I still stand by what Mike and I have been talking about really kind of towards the end of last year, early part of this year, is that based upon the way the Federal Reserve is raising their interest rates, the full effect of that interest rate hike is really seen anywhere from 12 to 18 months after the Federal Reserve starts raising interest rates. So the net effect that they're trying to do is to bring down inflation, therefore spurn spending and get the economy kind of going again. And what we've seen is that, you know, we hit our 12-month mark right around January, so 18 months is going to put us sometime between June and August. So, you know, we're really kind of seeing this push-pull effect on the market where we have a couple good days in the market and then we have one or two bad days in the market. And I think that's going to continue really until we get to the early part of the summer before we see the market really kind of start to take off. And, you know, what is leading me to this indication really is kind of the data that I'm looking at here. You know, one of the big things that came up was the collapse of the SVB Bank and two other banks. But, you know, the Federal Reserve on March 7th said that the bank is going to have to raise interest rates faster and higher than expected to get inflation going down, so that way they can get inflation controlled by the time they hit their mark. But shortly thereafter, like I said, we had a couple bank failures that really kind of jolted the markets and has started this speculation out there that the Federal Reserve might pause or even slow the interest rate hikes to get that financial security going. We've had this push and pull effect on the overall market, and it's still continuing. It's been going for months. You know, back in February, we added 311,000 new jobs. This preceded the month of, or followed the month of January, we had 504,000 new jobs. So, you know, there was a strong pace of hiring, which really leads to the U.S. economy is growing and substantiate these larger and more frequent rate hikes that are kind of going to follow. But on the other side, when I look at the decline in wage growth, you know, I've said jobless claims have been dropping, new jobs have been added. Those numbers are very high, they're very strong. Jobless claims, the unemployment rate, the gains in the labor force, have started to drop off, and the unemployment rate has fallen a little bit as well, which really is what is telling me from that aspect is that more and more people are starting to come off of the sidelines looking for work. This kind of indicates that the Fed is going to keep the pace of which they're going by raising interest rates and possibly in a drastic manner. You know, there has been some slow wage growth. Really what we've seen here, if you look at the non-supervisory and production roles, this blue line here, we can see that we started to see a fall off in wage growth, and it really is more to, there's been higher paying jobs that have been offered. So the non-supervisory workers has stabilized. You know, we've hit right around 5% for that number. We had a nice fall back, it popped back up, and now it's starting to go sideways. But still, you know, we're at a pretty high level of wage growth historically, right around 5%. It stays pretty strong. That's really kind of what it's looking like. So, jobless claims have fallen, unemployment rate has fallen. People are coming off the sidelines and looking for work, and wage growth, while it has fallen off these first couple months of the year, has kind of started to level out here. Another thing that we look at is the JOLTS rate, which is the quit rate, the willingness of the U.S. worker to quit their job with the anticipation of finding a new job. So this is something that's put out by the Bureau of Labor and Statistics. It is giving us this mixed signals. The demand for labor really started to drop off in January. That's shown by this yellow line here, this drop in job openings, but it hasn't broken through its low. It came back down and then it came back up. Our quit rate, that has started to fall off. So this suggests that workers are becoming less comfortable in leaving their jobs in hopes of finding a new one. The downward trend of the quit rate, our blue line here, does tend to suggest that worker confidence is kind of falling, although the worker confidence rate is still higher than we've seen over the past 20 years. But more importantly, those job openings, new jobs that are available to people has steadied from that perspective. So that is a good sign. But this kind of goes to that whole push-pull mentality of what's going on in the market. We have some good news out there, but then we have some news that kind of suggests it's a little bit different. One thing that I do really like to look at is investor sentiment. What we have here, this is smart money, so institutional investors. That's our blue line here. We can see the confidence hit a pretty low point in between January and March of this year, but now has started to pick up. Whenever that happens, the dumb money, not to say that it is dumb money, but the average investor, the average do-it-yourselfer investor, is showing that the average do-it-yourselfer is losing faith in the overall market. Yet, however, the smart money is feeling like the stock market is starting to come back. It relies on a series of indicators, looking at trends in the market. Often we see peaks when the trends become exhausted. So right here, we're starting to have this cross, which historically leads to more confidence in the institutional investors, which should lead to more money being flowed into the market and more upward movement in the market, really in anticipation of later on this year us having more substantiated growth in the overall market. Now, one thing that I talked about previously was, when are we going to see interest rates start to peak? When are we going to see interest rates start to come down? So earlier this year, this slide is from my last presentation. Really where it's showing is, what we think where the rate is going to target. And so sometime this year, the thoughts where the overall rate is going to peak somewhere between 5% and 5.25%. All these little dots here represent Fed policymaker and their projection where they think it's going to be. And then we're going to start to see the rate really start to fall off starting at the end of 2023. This is another slide that I showed, and this trend is really continuing this trend is still continuing to happen in the overall market. This is supply management, manufacturing. So what we have here is new orders for items. A lot of manufacturing that we're seeing, the orders for new items is starting to fall off. Production capacity is starting to fall off. This is really the net effect of the Federal Reserve raising their interest rate, trying to make things more expensive, so that way supply starts to build up. Well, when supply starts to build up, companies aren't placing new orders for new products. Manufacturing's not operating in that same capacity because there's not as much demand. So the demand has started to fall because supply is building up. That eventually leads to lower prices, bringing the overall inflation down. This is the overall goal of what the Federal Reserve has been trying to do over the last year. In the long run, expecting inflation to continue easing, which will allow the Fed to cut back on its interest rate hikes. That's really kind of what we're looking at, is when is the Federal Reserve going to start doing that? And this next graph here, what this shows us is kind of a different interpretation of this previous slide that I've shown over here. The recent turmoil that we've seen in the overall banking sector. There was a lot of talk about that 3 weeks ago about what's going on. It really did shift the fixed income market pretty drastically. The expectations previously were for the rate to be somewhere rising right around 5.5% or more in the next couple of months. Now, over the next several months, we think that we're probably going to be somewhere right around, so this was the previous line here, right around 5.5%. Now we think that the rate is going to peak somewhere in June. It'll be kind of leading to that whole turnaround of the markets, a little bit more substantiated growth in the market starting right around June, July, August. It's going to peak somewhere around 4.75 or 5%, followed by started to see rate cuts happen sometime in the second half of the year, leading into 24 and 25. We should see rates start to come down a little bit. Now, it's not going to be drastic. We're not going to see whole percentage point cuts, but maybe a few tenths of a percentage we might see. But a lot of this change in the difference between these two lines is what we thought, or what the overall market and the overall Fed thought was going to happen on the 6th of March compared to the 17th of March, was really just the swift action by the Federal Reserve to shield those depositors of SVB Bank and the other banks that actually failed. The Fed is still very concerned about inflation, and it really wants to bring inflation down, but it has a bigger commitment to maintaining the stability of our financial system. So it is possible that it could lead to a pause in interest rate hikes, but I think that what we're going to see is a more tempered approach. We're not going to go as drastically. That's kind of what we're seeing here with this yellow line. We're not going to see it peak around 5.5%, maybe closer to 5% is really kind of what we're going to see. China, they have something that they call a two-session parliament meeting that they do in early March, where all of the leaders of China's economy, which is the second largest economy in the world, sets their targets for their GDP. One of the things that we saw was their economic surprise index. Really what this is showing us is that they feel that they are going to have a very strong economy starting the second half of the year here. That's where we see this nice peak up here. It's kind of going up and down, up and down. Now we've hit a peak. This is a pretty new high. But, what we're seeing is that their economic data is exceeding the expectations for the first time in about 15 years. Their purchasing index rose to positive territory for the first time in 7 months. Business confidence over there is going really well. They think that things are going to start picking up. The biggest thing that they want to do with their meeting is, they put in all new leadership changes over there in China under the President Xi. The economic team really wants to hit their targets because they missed them last year. Really what we're going to be looking at with China is the MSCI index in China. Normally, this index performs its very strongest for the year in April and in November. So what we want to see is a positive number out of the MSCI China index in April, and that indicates that things are really going to get better in the overall market. It rebounded pretty strong from October to January. As I said, April and November are historically the best months of the Chinese stock market. It posted its best monthly return last year after their October meeting, and hopefully this meeting that they just had will see strong movement in the markets. There is no guarantees, but it does tend to be the most consistent month out of all of them. If we're looking at this line for April, more green than red, which is a good thing. So hopefully we see a green number out of China, which would lead to more economic strength for the overall markets. All of the volatility really leads back to what Mike and I talk about is sticking to that long-term plan. It is difficult to ignore a lot of the headlines out there in market noise, especially when you have things like SVB pop up and the FDIC stepping in. You have to remember that markets historically have always fluctuated and recovered. We want to make sure we're tracking progress towards our long-term goals of safe and secure retirement and not trying to focus too hard on short-term performance, because market swings really can make emotional decisions happen. We want to make sure we're keeping proper diversification, making our portfolios rebalance on a very, very normal period, and really being broadly diversified. Now, one of the things that we talked about a lot, one of the things we've done a lot is the bond replacement strategy. The bond replacement strategy worked extremely, extremely well when the Federal Reserve started raising interest rates, because as the Federal Reserve raises interest rates, the prices of bonds fall. Now, as we're getting closer to the point of the Federal Reserve possibly starting to lower rates, you will see the overall movement of the portfolio start to shift. Mike and I want to start, when we're doing our reviews this late spring, early summer, we're going to start talking about taking some of the money out of our bond alternatives and start going back into traditional bond allocations, because we feel now is probably, we're right around the peak of where interest rates are going to be. So when they start cutting the interest rate, as interest rates fall, the prices of bonds rise, and that's kind of the overall goal. So that will be part of the conversation when you guys are coming in to sit down with Mike, myself, Catherine, and our team at Prostatis. Let's start this rebalancing, getting us back to what a normal allocation should be under normal market conditions. And this is going to leave us better positioned when the markets do change their direction, and we do have that substantiated growth in the overall market. That is everything that I have for you guys tonight. I hope you enjoyed. If you have any questions, please feel free to shoot me an email. My email is Ryan, R-Y-A-N, @prostatisfg.com, or you can call me in the office. The number 410-863-1040. I will be extremely busy the next couple of days trying to get us through the tax deadline, but once we get past that tax deadline, we're going to start seeing everybody in our new office, and shortly soon we're going to have a grand reopening. I know a lot of people have seen the office expansion that Mike and I did, but we're planning on having a rather large party for everyone to come in and really enjoy the space once we have it all finally decorated and some of the construction is finalized from that perspective. But I hope everyone has a wonderful evening and a great rest of April, and I will see everybody in the office shortly.